And I just had as many phone calls as I could. And again, at this point, it's not like I had a deal. So it was the best time to do it because I genuinely wanted to get to know the people in this space. And, found out that people were very open to talking about what they do and what they love to do, what their passions are, and what their goals are.
If you're an active real estate investor and you're looking to do larger deals, you're in the right place. We are going to go and take the conceptual type of stuff that you listen to from other real estate podcasts and bring it down to the tactical, the nitty gritty, the actual actionable types of things that other real estate investors that went big did to grow their own real estate empire. You're listening to the Go Big Live podcast. I'm your host, Matt Druin. Okay, welcome to the Go Big Live Real Estate Investors podcast. I am your host, Matt Druin, and I have an awesome guest in today, Mr. Brandon Jenkins, who's founder of Birch Prosper and host of the Capital Stack podcast, which I'm a listener to, so you should listen in on as well. Brandon's expertise spans both the single-family residential and multifamily commercial spaces with a diverse professional background in risk analysis, project execution, asset management, and investment evaluation. In this episode, Brandon shares his insights on scaling up a real estate portfolio, the benefits of value-add investing, and how to make the leap into larger deals. As a successful investor with over 2,300 units in key Texas markets, Brandon has the experience and know-how to help you prosper in the world of real estate. Brandon, thanks for coming on the show, man.
Hey, man. Look, I really appreciate you having me on the show. I really appreciate being here, adding some value, hopefully, to your listeners. And thank you for the introduction. Thank you.
Yeah, absolutely. So I like to start the show out with, you were born and now you're here. What happened in between? Cliff Notes version.
Cliff Notes. So you know what? Normally when I give sort of my origin story, I start off kind of right after school, because that's when some of the things that are that I usually point to that are a little more material to where I am now took place. But I had a conversation recently with my father, and he kind of pointed out that, when I was younger, before I was of legal working age, because I'm in DC, and the working age at that point was 14. And so even before I turned 14, I was like, hey, Dad, I want a job. Hey, Dad, I want a job. And so I went down to like a lot of the retail centers kind of close to where we lived. And I would put some, slacks on and the shirt and the tie and say, hey, listen, I want to work. And they said, well, you're too young. Ultimately ended up working at like a pet store or something like that. But but it's as odd as it sounds. My work ethic, it really was sort of something I developed very early on. But let's fast forward a bit, right? So I worked professionally for 10 years as a petroleum engineer, and that's where kind of a lot of the attributes that you mentioned there in the intro really came into play. It's if nothing else, being a petroleum engineer, I worked as a drilling engineer and a reservoir engineer and an asset engineer. It's a big risk management type of play. Ultimately, there's capital risk, personnel risk, safety risk. There's all kinds of risks that come into play. And so I would sum it up maybe by saying it that way. Long story short, oil and gas is a very turbulent industry. It's a great industry when things are good. When things are bad, it can be very difficult. And so things got bad. I was in the industry and I worked through 3 different downturns. The second downturn is the one that was most impactful on me. I didn't lose my job, but I saw a lot of people who, I really cared about, I worked alongside, get laid off. And so I wanted to do something to offset that risk. So I started to get into single family real estate, and I would do the BRRRR strategy, right? So I got to 12 properties and I wanted to scale. So started to get into multifamily syndication deals as a limited partner initially. Started off with a couple of deals that were out of state. And so we can, dig into that a little bit, but ultimately got to 11 deals as a limited partner. And then, try my hand at being an active partner, which I am now, a GP, sponsor, whatever you want to call it. And so that's the long and short of my story there.
Yeah. So you got your experience in the small single family residential. What was that, sort of seminal moment where you were like, hey, this single family thing, it's great, but maybe it's not the thing? Like, tell me about that.
So the properties that I bought, so they were just an hour outside of Houston. Okay. Early on, I developed of the many criteria that I had established. One of them was I didn't want to buy in a floodplain or a flood zone. And so I did that. I stuck to that. Every property I bought was outside of it. But we had a tropical depression hit one day, and it completely destroyed the flooring that we had just installed in this. It was a beautiful home. And it completely destroyed it. And we didn't even have a tenant in there yet, which is, I guess that's probably a good thing, right? Because it's a little easier to get in and fix it up. But it really hit me at that point. It was like, as great as the cash flow can be on a monthly basis, you have these events. Now that one, maybe not as common as that, but you can have a compressor go out. You can have some plumbing issue, which I had both of them. So you can have these things happen that unless you have a large portfolio of single family properties, it can really wipe out your cash flow. It's, that's the reality of it. Unless you have a deal or property that's spitting out tons of cash flow, usually people you call it good if you've got about $200 a month in cash flow per door. That's pretty good. But it's also easy for something to wipe that out. And so that was what I discovered. And so I said, well, how can I at the very least offset this vacancy risk? There's all kind of other things to consider, but that one was a problem. Vacancy risk and also the risk of a loss of cash flow through some of these events. So I started to look for deals where I could reduce or mitigate that risk. And right off the bat, buying apartment deals, multifamily deals. If I have a 100 unit or a 50 unit, whatever it is, and I have 5 units or 10 units vacant, I don't feel that sting quite as much as a small portfolio of single families when it's vacant and I'm losing that revenue. So that's kind of what sort of triggered me to look elsewhere.
Yeah, absolutely. So let's talk about that big deal that you want to talk about today, and kind of talk about the origin about that and how you brought that full circle and everything you learned and everything that was involved with that.
Absolutely. So one of the things that I discovered when I made the transition from single family to multifamily, the first thing I knew that I wanted to invest in larger properties. So I wanted to go for 60 doors and north of that, or even closer to 100 doors. I quickly discovered, as a single family investor, you wear all the hats. And so granted, you're going to have to farm out some of the things that you can get involved with, professionally speaking, legal and, as far as the transaction is concerned, these kinds of things. But you wear all the hats. On the multifamily side, you can try to wear all the hats if you want to, but I believe that more often than not, you're setting yourself up for failure. And so I was able to sort of see that without experiencing that early on. So what I started to do was seek out groups that had high performers in the group that had great success in the multifamily syndication game, and where they were sort of open and willing to share and potentially partner, these kinds of things. So I sought out a group, many groups, but one of them that's made the most impact on me. And, I started to invest in some of the deals very quickly. And I went to their meetups before I invested in the deals, right? So they had meetups in Houston. I would go meet with the sponsors. I would meet with some people who invested with them before. I got to understand the culture of the group, and I really liked it. Okay. So I did those things first, and then I invested in their deals as a limited partner. But several of the people in the group really made an impact on me. Their stories really resonated with me. I liked their communication style. I got to see firsthand how they treat people, how they respond to people, how open they are, all these things. And so I started to build a relationship with some of the people in the group. So 2-3 years down the line, after I had already invested in a couple of that particular sponsor's deals, he took me aside and said, "Hey, listen, we've got some things that we're working on, and wanted to potentially see if you had the bandwidth to partner." And what's interesting, so the first time he reached out to me, as try as I might, I knew that I didn't have the network. I knew I didn't put the work in to make sure that if I pick up the phone or if I send an email or whatever it is, that whoever's on the receiving end of that would say, "Oh yeah, I know that Brandon's raising capital for a deal. He's an operator of these things." So anyway, I started to put the groundwork in after that first request. So the second time he reached out, then I had already built up pipeline funnel. I had outreach, I had exposure. And so it was easier then for me to now start raising capital for this deal. So that's sort of how it came about. Now, but to talk about the specifics of the deal. So I invest in markets that are business friendly, landlord friendly, right? We all talk about growth. So I want a strong net migration. I want a strong job market. This particular market had all of the things that you want, and new development that's taking place around the location where the deal was, but it was still supply constrained with respect to apartment units coming online. So it really was new development, but not necessarily a ton of new apartments coming online. Mm-hmm. Okay, so it had all the components there. One of the things that made it so great, I would say one of the strongest selling points in this particular deal was that we assumed the loan on it. I'm not sure how specifically we want to get into it, but I'll say that we assumed the loan on it. It had long-term, it was a HUD loan that we assumed. It had long-term debt on it. It had fixed rate debt. And if anyone, has been paying attention to what's going on in the market, if you can get fixed rate debt at a low rate, then you're in the money. And so we were with this particular deal. So those are some of the things that really kind of helped me, say, absolutely, I want to be a part of the team. I knew the sponsor. I like the market. I like the deal. And yeah.
Yeah. So you were approached by this person that you were in a meetup with, or, did some masterminding with, and the light bulb went on when he approached you. Do you want to be a partner in raising capital and helping raise capital for some of our deals? Am I characterizing that correctly?
Yeah.
Okay. So this got the wheels turning. And so you're like, well, I got to expand my network because, I'm not in a position right now to do that. How did you go about that in terms of building that network with intention to start, kind of planting those seeds so that when you came with a deal for them to invest in, that they were going, you're going to have a successful experience?
Yeah, that's a great question. So one of the things that I thought about doing was to give as much value, add as much value to people as I possibly could. I did that through, I started a newsletter, launched a podcast, like you mentioned, and that kind of helped with the education piece. I started to give away value-added content, to my network, things like, LP calculators, FAQs, things like referring them to articles, all these things that I started to do to say, how can I give as much value as possible? And how can I set up, as many, the phone is, to me, in my opinion, if you can't do in person nowadays, you still have to hop on a phone and make some calls. So I made a ton of calls, set up a bunch of calls. I filled my calendar. That's maybe the best way I could say it is, when he asked me the first time, my calendar was empty. Mm-hmm. Okay. So with respect to real estate investing, multifamilies, I had an empty calendar. Mm-hmm. And shortly after he asked me, I had an epiphany and said, well, this thing is just empty. I need to fill it because I need to have some appointments, right? I need to have some calls, conferences, all these things. So I went about filling my calendar with the things that I was passionate about. Mm-hmm. And then, shortly after that, then I started to see the results. So that's sort of the, kind of how I went about doing it. It was intentional networking, like you mentioned. I started to focus more on branding, adding value, giving value, and also the mechanics of this can't be ignored either. So I had a CRM. I had to purchase and set up a CRM so that I had these touch points with people very conveniently. I had to set up Calendly so that I can very conveniently book appointments and manage my schedule and things like that. So a little bit of both, kind of just making sure that I added value to my network was ultimately what I did.
Yeah. So how did you know how to reach out to? What did this calendar look like? Were these kind of action steps in terms of you fill out a calendar in terms of time blocking? And also, who did you know how to reach out to in terms of having these conversations about an opportunity to passively invest in real estate?
So two things. One is conferences. So I went to a conference every month. This was last year. And the year before that. So I went to a conference just about every month. So I met as many people as I could, but I also was intentional about who I wanted to meet. So both partners and potential investors. So that's one. The second thing is virtual meetups. I for a long time, I was going to at least one virtual meetup every day. Wow. So I was busy. And so what people would do normally is because, we're still mostly using Zoom for these events. So what people typically would do is put their information in the chat. All right. Mm-hmm. And they'll put, hey, I'm Brandon Jenkins and here's why I invest. I have a potential deal that I'm working on, or whatever it is. Let's connect. You know, you don't want to start with, you know, I have something I'm working on. It's usually just, hey, here's my name, here's what I do. Let's connect if you're interested in just having a conversation.
Yeah. Oh yeah.
So I noticed that people would fill the chat log with theirs. So I came up with a little blurb for myself, and I just had as many phone calls as I could. And again, at this point, it's not like I had a deal. So it was the best time to do it because I genuinely wanted to get to know the people in this space. And, you know, found out that people were very open to talking about what they do and what they love to do, what their passions are, and what their goals are. And so for me, it was every day I had at least, you know, 3 calls, and I was in a virtual meetup every day. So those were the 2 things: virtual meetups, conferences, phone calls.
Yeah. What type of virtual meetups were this? Was this something you were finding on like meetup.com or like Clubhouse?
A combination. So you can go right now, if you go on meetup.com and you look up multifamily meetup, or if you look, in fact, if you're interested in virtual, because you know, if it's not convenient for you to go in person, you can look up virtual, you know, apartment meetup. So there, LinkedIn. So a lot of people on LinkedIn, if you're once you're plugged into the syndication space, then you'll get frequent updates about people who have these meetups. So maybe not as much on Facebook. I mean, I tend to see a lot more on LinkedIn and meetup.com. Those are the places where I went.
Okay, absolutely. Yeah. So you were, you know, building this network because you felt that that's how you could deliver value to the partnership, right? In wearing that hat, for instance. So you're filling up the calendar, doing this. Take me a step forward, because there was an opportunity that came up, right?
So the opportunity finally came up, and where I felt like I, you know, kind of done the work to make sure that if I you know, let someone know, hey, I had a deal that I'm potentially working on, that they wouldn't be shocked. So so an opportunity came up, and it was in it was in a market that just had an explosive growth. But you know, all the right sort of elements of a deal, and that's actually the fixed rate deal that I referred to there. But so the opportunity came up, and this particular gentleman reached out and said, "Hey, let's have a conversation." So we set up a call, and you know, after that, at that point it was just a letter of intent, so it wasn't under contract yet. But so I joined the team, and you know, it's co-GPs. There's several of us on the team, and then there's 3 lead general partners on the team. And so we just kind of figured out the mechanics of, you know, how we're going to unify the message so that when we do send it out to our respective networks, that we're all aligned. And that's kind of how we went about kicking it off. I had to also, you know, I mentioned the CRM, but also had to set up a portal, right, an investor portal, so that people could go there and look at the deal if they need to. That's kind of how it came about, was just through, you know, he reached back out and let me know he had something that he was working on. And so we talked about it. He told me the high points of the deal, and right off the bat, I knew it was a home run. So, yep.
Wow. So this came from a relationship. You worked on building relationships. So this was a deal that, I mean, you didn't even find yourself. This was something of somebody you knew, a relationship that brought this to you. So, so how did you work out in terms of, like, you know, for those of you listening, you know, GP stands for general partner. You know, Brandon's job was to bring in LP equity, right? Or a limited partner equity. These would be the passive investors. Okay. So how did you negotiate or kind of split that between, you know, with the you know, that GP group you had together?
That's a good question. So the first thing I'll say is, for me, that's not my sole role, is to raise capital. It's also to assist with the asset management, right? Because this was in this particular case, it was a 506B deal, which basically means, well, regardless of whether it's a 506C or 506B. And I don't know if you want me to go into kind of the definition of those, or just skip that.
Yeah. We haven't had a guest on it. There's the term that's been thrown around. I know what it means, but yeah, tell us.
Okay, sure. So the long and short is, you know, these syndication deals typically fall under the SEC guidelines of Regulation D. And if it's a 506B deal, then that means you can have what's called both sophisticated and accredited investors. If you're accredited, then the 2 criteria that most people are going to look at is either you have more than $1 million in net worth, or you earn more than $200,000 a year in annual income yourself, or a combined income of $300,000 a year. If you're sophisticated, then basically the SEC wants you to have an understanding of the risks associated with an investment like this. So if it's a 506B deal, then you can have both sophisticated and accredited investors in it. But you can have a limit of, I think, 35 sophisticated and unlimited accredited. If it's a 506C deal, then it's accredited only. One of the key differences between the two is that with the 506C, you can publicly solicit the deal. With a 506B, you cannot. Okay. And so yeah, in this case, it was a 506B deal, and I completely forgot my point with this. But,
sorry, we go back and forth. So sorry about that. So yeah, so you were we were talking about how you negotiated the general partnership in terms of the splits and that sort of thing.
That's right.
You did let us know that one of your responsibilities was asset management, but let's start with the kind of the general partnership.
Sure. So I'm sorry about that. Okay, so the reason I went through that long that description there is because one of the things that's important with these kinds of deals is you have to have a substantive role in the deal. So it's not. So I wouldn't be able to strictly raise capital and be compensated for how much capital I raise, as an example. Now, in this case, it's experience level and a few other factors that come into play. The leads on the deal. If they have multiple, north of 5 exits, some of them have, around 10 exits or something like that. And so they're going to have the lion's share of it, and they're going to be play a more substantive role within the asset management piece as well. So although I'll be helping out with asset management, it's to a lesser degree than some of the leads, right? So that's kind of how it fell out. We all raise capital. Everyone's on the deal. We're going to bring capital to the deal to have skin in the game, but we're also going to raise capital. So in terms of negotiating it, it was really just a conversation around experience level, that sort of thing, what I could bring to the table. And then we all agreed. And then that was the kind of where we landed.
Okay. And then what was the proposed structure between the general partners and the limited partners on the deal in terms of, splits, what your guys promote was, that type of stuff?
So with this one, it's an 80-20. And it's actually a flat split. So it's not, it doesn't have, kind of a hurdle or anything like that. That's more complicated. So really, well, actually, let me change that. So there's an 80-20 split. The only time that it adjusts to a 70-30 is once the LP investors double their capital. So only once they double their capital, then it becomes a 70-30. And so if they do not, then it stays the way it is. But outside of that, it's a straight split.
Okay. And then was there a preferred return involved with the LPs?
No, in this deal, there's no preference.
Okay. All right. Sounds good. So you brought this out. You went out to your network that you've been working on filling your calendar with, and you had a unified message between amongst the general partners as to how this, how you're going to present this deal. What happened then? Was this you sent out an email blast to the people that, you had this with? Did you, get on and you melted the phone line, to, call these people saying you had an opportunity?
So typically what we do is, and what we did with this deal is to send an email out when the LOI went out. We sent a quick little update just to say, hey, here's some details about the market that you're going to love. Then we sent another one when the contract was signed. We sent another one when we wrapped up due diligence. And then when we had the webinar that came out, okay, so where we all presented the deal and then say, okay, hey, the deal is now open for subscription. And then I think another email kind of after that we sent out just to say, hey, listen, here's some more high points of the deal in terms of new development that's taking place. So that was the communication, just to kind of keep it fresh and stay top of mind, because that's important nowadays. It's always been important. Outside of that, yeah, I mean, phone calls, for me, I think that always helps. You have to. One thing that I advise to people is when they are trying to raise capital, you have to, it's easy to think that people are always thinking about what you have going on, but they're just not. I mean, you know what I mean? So people have their own lives. And so even with what I just laid out as sort of the campaign, if you will, sort of the marketing campaign, the reason to do that is not to spam people's inboxes. It's really just because email gets buried. You send something out and they might look and say, that's an incredible deal. But a month later, it's buried. They'll never see it. So you have to do things to let them know, hey, here's how we're progressing, but also to stay top of mind. So it was that, I manned the phones, have to do that. And it also was during the time where I was still kind of going to a few conventions here and there. So I also kind of had some face-to-face with people who I already knew, right? Because it's a 506B. So yeah, that's kind of how it went. A combination of those things.
Okay. So you all successfully raised the capital. You closed on the deal. It was a loan assumption. So did you put a supplemental loan on this, or did you just raise the balance of it in equity?
We just raised the balance. So we didn't need a supplemental loan. And okay. I will say in this case, another thing that sort of helped the investors, especially given what we're going through now in the market or what we were going through at the time, was it was a very, very low leverage deal. Mm-hmm. So we brought a lot to the table, but yeah, we didn't need a supplemental.
Yeah. So what was was this a value add deal?
It is a value add deal. Now so here's what's interesting though, is it's a newer construction. Okay. So it's a 2021 construction. And there's some value to be had in that there's two things. One is that there's a substantial loss to lease in the deal. So the deal was acquired from a developer. As you know, typically a developer wants to make sure that they fill the property, not necessarily maximize rents is not usually the goal, because they want to make sure that an operator can then take on the property, right? So in this case, there are some minor value adds in terms of like CapEx projects, but a good portion of that value is burning off the loss to lease. So it is a value add deal in that respect. Yeah.
Yeah, absolutely. Love it. So you purchase a stabilized deal, right? Mm-hmm. And the value add was pretty simple. It wasn't like a distressed deal or anything like that. Mm-hmm. I've been on the development end where we've done new projects and we are trying to convert from construction to permanent financing as quickly as possible. Yeah. So we're, when you're a new project in town, it's like, it takes a lot of marketing to get people in through the door. And you make concessions on the front end to get that thing bankable. So that's actually awesome that you were able to step in and take it through that sort of next round of stabilization process to push that asset value. So tell me what happened from there.
So we still are in the process of closing on the deal, mm-hmm. But yes, I mean, as far as kind of we just made sure that we had everything tight on our end, which we do, and we're close to that. It's one thing I wanted to point out is that's interesting that you mentioned there is in terms of stepping in. As an operator, another deal that I'm a GP on, we use a similar strategy, but we also took on the risk of lease up, which that was a little different, right? Because when we acquired the deal, it was 50% leased up, and then we said, hey, we'll take it and we'll do the remainder. So a lot of opportunity there, but
yeah, absolutely. Well, we're getting close to the recorded portion of the show on the podcast, so. In conclusion, kind of for people that are looking out there to go bigger on their real estate deals, because a lot of our listeners are ones that are doing small, single family, multifamily, like what's some advice you'd give them if they're looking to make the leap?
The advice that I would give is to try and align yourself with someone who's had success in larger deals. That in my opinion is the fastest way to go big, because you might be able to do it yourself, and that's all right as well. But I believe that it's worth your while to compress the learning curve. And I think that one of the most effective ways to do that is by finding people who like and trust, but who have also had that level of success, and then having a conversation with them.
Yeah, and made a lot of mistakes in the process that took years off their life.
That's right.
They say, oh my God, I got this gray hairs here, man, like for a reason. So, hey, Brandon, thanks for coming on. Hey, if you're listening right now and you want to get in a live Q&A with absolute beasts like Brandon Jenkins, Definitely make sure to come into the Go Big Live Real Estate Investors Facebook group. We stream these episodes live and open up for live Q&A after the recorded portion. And you can get access directly to successful real estate operators, syndicators, developers, just like Brandon. So be sure to check that out. Brandon, thank you so much for coming in today as our guest.
Absolutely. Thanks for having me.